Welcome to our channel. If you're ready to dive into the exciting world of day trading and swing trading, you've come to the right place. In this video, we'll unravel the fundamental principles of technical analysis that will set the foundation for your successful trading journey in 2023 and beyond.
Hello and welcome to Technical Analysis Course Introduction by Wealthy Education. What you'll learn in this course is a complete technical analysis system, how to trade profitably using technical analysis, how to perform candlestick chart analysis, how to trade long and short candles, how to identify support and resistance levels, how to predict market moves and directions, trading psychology and risk management strategies. And as always, at Wealthy Education, you're going to be learning with real-world examples. So sign up for the course. Let's get started. I'll see you on the inside. In this first video, I'm going to do the most basic of instructions. I'm going to teach you how to read a candlestick because, after all, it's going to be impossible to glean any type of information from these charts if you do not understand the symbols in front of you. A candlestick is simply another version of the bar chart. In other words, there is the open price, the high price, the low price, and the close price. And you may be familiar with something like this. And you might have a bar that looks like that. You may understand that we opened at this price, we reached as high as this price, fell as low as this price, and closed at this price. Well, a candlestick it shows you the exact same information, but it also does it with color coding. Now, typically it'll be red and green, red being a negative candlestick, green being positive, or you may see black and white charts, for example, and that would be black as negative and white as positive. Now, it can be any color scheme, but those are by far the two most common. So, when you see a candlestick, you'll notice that there's a fat part in the middle, and there may or may not be wicks or shadows, sometimes they're called, on the candlestick. So, in this case, what you're looking at is let me go ahead and color this. So in this case, let's say it's green. So we already know that it's a positive candlestick. The price has risen during this candlestick. This candlestick in this case happens to be on the daily chart. So we can take information from that. We know that just like the bar chart, there's your low. That's the low of the session. This is the high. That doesn't change. But what does change is this is the body of the candle. And this is the range in which the market opened and closed. This is your tick to open, and that's your close. Now, how do we know which one's which? Well, you have to use a little bit of common sense here. So, for example, if the candlestick looked like this, and instead of it being green, it was red in the center, well, you know that price fell during that time frame, in this case, day, like I said. So we know that that's open and closed because the close is lower than the open. It's really that simple. There's not a whole lot more to it than that. There are some things about candlesticks that you need to keep in mind. Some are more important than others, and there are multitudes of candlestick patterns. But more importantly, when you see something like this, you recognize very quickly at a glance that there's been a lot of negative activity there, and therefore we're probably in a downtrend, or at least in a major pullback, something to that effect. Obviously, very, very bearish, negative momentum. The size of the body matters. because it suggests that there might be a bit of conviction. So, for example, on this Walmart chart, you can see that this candlestick is pretty long. And what does that long candlestick tell you? That long candlestick tells you that there was a lot of selling during that particular session, just as this candlestick here shows you just how bullish Walmart was. And beyond that, I would submit that closing at the very highs of the day would matter as well, because there's no wick above. It wasn't like there was any selling at the end. So that's a very bullish sign. So keep these things in mind, because the psychology of the market is being shown to you on this chart. So that tells you that there was real conviction, just as this candlestick here tells you that they tried to rally, but they gave back most of it, and just how weak the buyers were by the end of the day. So that tells you that perhaps they may be struggling, like over here, for example. You could see that the sellers really struggled here, struggled there, but they did continue. They broke through their struggles and persisted. So all of this is about psychology. Now, obviously, you're going to learn a lot more about candlesticks than that in this course, but just keep in mind, every time you see a candlestick, think about what's going on there. The sellers have overwhelmed the buyers here, and therefore it makes sense that we continued to go lower, just as it makes sense that with the buyers closing at the highs of the day, it makes sense that we have risen from there. In this video, how to trade long and short candles. So candlesticks, as you can see, change shape and come in all different sizes. I have Tyson Foods daily in front of you, but this could be any chart. It really doesn't matter. There's a couple different things that you should think about. The length of the candlestick does in fact matter. So on this daily chart, you can see that we had been trending lower. But think about what these candlesticks mean that are longer than many of the other ones. And in this case, negative. There are three days here which only make up about half of this distance. So what does that tell you? It shows that there's real conviction that day to the downside, because not only did we form a long candlestick, but we closed towards the bottom of the candlestick. Generally, the bottom quarter is a pretty negative sign, just as the top quarter of a green candlestick is generally positive. But you also want length, and there is no hard and fast rule for this. It's just common sense. So for example, I just said that closing at the top 3/4 of a candlestick is a bullish sign. It doesn't mean that it works every time that the buyers are going to continue to take over. But so after this candlestick, we had a gap, and gaps tend to represent a lot of either buying or selling, in this case selling. And we had a couple green candlesticks that formed after this massive one that closed towards the top. Now, that could be thought of as somewhat bullish, but think of it this way. It took two of them just to get back all of the losses from this one candlestick. And that's the point. Just like over here, this candlestick was very negative, and even though we popped above it, you can see that we saw more selling later. So with these long candlesticks, it shows that something either has fundamentally changed or has been, in this case, confirmed as we were falling. So let me pop up another random chart. Let's do city. Here you can see that we have several negative candlesticks followed by declines, but we also have several positive candlesticks like that followed by markets accelerating to the upside. For example, this candlestick here wiped out 3 or 4 days of trading, and we shot higher from there, just as we had a couple of really negative ones, and then it started to decline. Let's go to JP Morgan, and you can see that this really bullish candlestick here wiped out 3 or 4 days of negativity ahead of it in one massive move and what would have been a slightly positive trend anyway. So that makes sense that we would go higher. When you see a cluster here and then a sudden flush, that's a very negative sign. Look at how negative this candlestick is in comparison to this range. I mean, we wiped out that entire range in one candlestick. So keep that in mind. That really shows conviction. That shows a lot of money coming into the market. Now, on the other end, you have short-bodied candlesticks, and they generally mean indecision. What you want to see is short candlesticks followed by some type of massive negative candlestick like that. So it's not the short candlesticks that are the signal themselves, but it tells you that you want to see momentum pick up in one direction or the other, that maybe the market is trying to wind up a little bit. The long wicks can mean things. So, for example, think about what this candlestick here means. That long wick suggests that the buyers came in but gave up quite a bit of the gains. Well, that's not a good sign. That means we could not keep up the momentum to the upside, and that, in fact, is a bit of a reversal signal, in this case, a shooting star. Just as this is a hammer. So on this candlestick here, on this day, we were at extreme lows. We had fallen and did that. So this shows that everybody who had shorted this candlestick down below $107 was now underwater. And then once you got this very positive and bullish large candlestick after it, more people started to lose money. And you can see we just took off to the upside. These are things that you need to think about when you're looking at these candlesticks. You need to think about who's in trouble. There are people trapped when you get a huge move like that. The sellers here were trapped. And in order to get out of a negative situation, you need to buy that stock back. So not only are they losing money, they have to push the market higher to close out all of those short positions as well. In this video, I'm going to talk about multiple time frame analysis. So when you're looking at trading a stock, and this is especially true when you're talking about day trading, multiple time frame analysis is absolutely crucial. So the first thing you need to determine is, what is the trend? In other words, is the market gradually going up like we see here on the Apple daily chart? Or is it gradually going down like we see here on the Deutsche Bank chart? You can see clearly over the course of the entirety of 2018 so far, the market has certainly been selling Deutsche Bank. So that in and of itself gives you the overall bias. There's also something called consolidation, which are just simply time frames of a cycle, if you will, where the stock really isn't going anywhere. So, for example, each one of these candles represents a day. For a couple of months, Apple really didn't do anything, and that's called consolidation. This will dictate exactly how you approach a stock, if you will. One indicator that we will talk a lot about in this course is volume. You can click on indicators on the TradingView platform and then go to volume. Just click on that and you're good to go. And you can see that the volume shows up at the bottom of the chart. It's color coded by the candle. So this was a green candle, for example. So that's a green bar. The higher volume, the better off you're going to be, especially day trading. So watch what happens. This is an hourly chart of Apple. Let me go ahead and put that volume back on. And you can see the volume's lower, of course, because each one of these is an hour, not a day. But watch what happens. It shows on certain candlesticks, much more volume. And that gives you an idea as to how the market participants truly participated in that particular candlestick, for example. Gives you an idea of conviction, if you will. How to use multiple time frames? Well, that's essentially what we're looking at here. We're looking at a longer term uptrend. And there is, for those of you who know anything about patterns, there is a pennant forming, which is a bullish pattern. We're in an uptrend. So when you look to Apple on the short-term charts, and in this case, it's an hourly chart. It could be any time frame, 15 minutes, 5 minutes, whatever it is you're dealing with. You need to be looking for buy signals, candlesticks that tell you, hey, it's time to get involved, and hopefully with an extreme amount of volume as well. That typically will lead the way. So now that we know what we want to do and which direction we want to take the chart, we then can ignore selling opportunities because we know that they are less likely to succeed over the longer term. When I mentioned previously that we were in an uptrend, then you start to look for signs, perhaps like an inverted hammer here. That's a candlestick, breaks to the upside. And once you break that, that's a good sign. And you can see that we have gained from there. So that's just one example. And this is all based upon the fact that Apple has been rising over time. That means there's much more interest and much more volume to the upside. The larger institutions are getting involved. And therefore, even though it had been choppy for a couple of weeks, it still, over the longer term on the hourly chart, as you can see, has paid to be long of Apple, not short. Here's a 15-minute chart. See, it looks pretty gruesome there, but when you start to fade out, it's a completely different scenario. You can see that, again, even with these nasty pullbacks, it's still, over the longer term, you continue to do better. And remember, to the upside. And remember, that's exactly what this is about. This is about playing the odds. You're never going to get it all right. So, as a quick example, before we cut out of this, you can see that there's a gap there. And when you blow through gaps, typically there's a lot of selling pressure there. And you can see that we did have a pretty negative move right there. When you return to the gap and you blow through it, that's a very bullish sign. So, for example, above 224 might be a very interesting place to buy Apple because you have the weight of the market longer term with it, and it is a bullish technical signal. Again, though, volume helps, and I would urge you every morning before you start placing trades, look at the longer term charts and pay attention to whether we are with the trend or against the trend. Being against the trend, really not a very smart thing to do. Deutsche Bank, as you can see, has broken down multiple times, shooting star right into a gap, selling opportunity, but you could even go as far as going down to the 1 hour chart and start looking for selling opportunities. At this point, if we blow through this gap, that would be a negative sign, probably have short sellers coming into play. Now, I will point out volume is crucial on a multiple kinds of levels, not the least of which is getting in and out of a stock. As a day trader, you do not want something with a spread that's going to be 5 or 10 cents, a less liquid stock. A day trader is going to want to be able to get in and out, not lose 6 ticks trying to get filled. That's also important. So day traders tend to stick to larger stocks such as Apple or the SPY or a JP Morgan, that type of stock. Stick around. We'll talk about support resistance trading strategies next. In this video, we're going to keep it simple. We're going to talk about the most basic thing that you will need to know, and that's support and resistance. On the TradingView platform, there is a line over here on the side, and if you click on this little arrow, it expands the menu out. I'll be using the horizontal line to draw support and resistance lines. And you can see that if I click on the chart, it pops up. There's a little bubble, which allows me to drag it back and forth. And you click away, and it goes away. So, support and resistance. support and resistance are simply areas on a chart that buyers or sellers cannot break through. So if you can imagine a stock or any financial instrument for that matter, trying to break above this area here and failing, that is the market resisting price from going higher. The market doing something like this and finding a level where we can't break through to the downside is said to be supporting price. So it's either resisting or supporting an uptrend. It's based upon an uptrend, although it works in both. So you can take this line and you can draw little areas. And the first thing that I would mention is you can see where price was resisted at this area here previously, and a lot of selling pressure came in. But when we broke above it, buyers started supporting the market right in this area as well. And that's something called market memory. So market memory is based upon, and I'll go back to our example here of resistance, but it does work in both directions, of perhaps sellers coming in at this level, $215 in this case, and they continue to sell. Well, what happens when we finally break out? Well, when we finally break out, there are a couple different groups of people that will be noticing this. Number one would be the sellers who are losing money. If the market comes back to test this area, they are willing to get out and perhaps even reverse their position with a smaller loss than they would have had up here. So they have an inclination to close their short positions, which means they have to buy the stock. The other group of traders will be the people who missed the move entirely and are waiting for a cheaper price to get involved, what could be a move higher. One way to think about this, an old axiom, is what was once the ceiling becomes the floor. So think of support and resistance levels on a chart like this, and think of it perhaps as a cross-section of a high-rise. So if you're in the first floor, second floor, third floor, etc., if you go above this resistance, which was the ceiling of the first section, it should now be the floor of the second section, or the second grouping of trading, and so on. So what was once the floor becomes the ceiling if you drop a floor. It's a very similar idea. Support and resistance tends to be found at round numbers. So for this example, you could say maybe 1 to 80. And that's because large order flow tends to happen at large round numbers because, unlike us, some of these large houses are coming in buying millions of shares. So they have to continually buy in this area when it pulls back, because if they buy too many shares in one shot, it'll make the market move against them. Those of us that are retail traders, we don't have that issue. So let's go ahead and take a look at what this looks like in an uptrend. Well, you can see clearly that somewhere around $140, Apple has been supported in the past. You can also see that we had seen some trouble here. Resistance happened. Now, we did break down below here, but there's also a gap there, which is somewhat supportive. You can see we broke down below here and then turned around to form a hammer, which is a very bullish candlestick. And couldn't even get back down here the next time. So you can see this does tend to repeat itself. And as I draw these lines, you can see that there truly is an order to the market. It's not as random as a lot of people think that it is. Now, does this always work? Well, of course not. There are times where support and resistance fails. But at the end of the day, it gives you a guideline. So typically what we like to do is we like to say, okay, well, we have our lines. We need a candlestick or some type of pattern or something to confirm. So this breakdown and this hammer being formed on this daily candlestick at this level confirms for us that there is support coming in. Another thing that you should pay attention to is on this candlestick, there was a lot of volume. So that shows that there's real strength there. There's real conviction in buying. Or, in this case, it could have been real conviction in selling, but guess what? They're losing money the next day, so they have to short cover. So there are a lot of different ways to look at this. But one thing, here's a bearish engulfing candlestick at 180. The volume wasn't great, but it was a bearish candlestick. So this is a much better signal than this one, but both are certainly valid signals. Another thing that you'll want to pay attention to is that we've been in an uptrend, so this may signal more of a pullback as opposed to a shorting opportunity, because you always want to go with the trend over the longer term. Now I'm going to go ahead and remove all of the lines and talk about Fibonacci. So in this case, I'll go ahead and use General Electric. Fibonacci is a mathematical formula that was discovered by a mathematician many centuries ago named, you guessed it, Fibonacci. And what he recognized is that there were patterns that repeated themselves throughout nature. Now, without going into the math, the idea is that you have a trend up or down, and typically they will pull back before they continue going higher. I mean, that's not a huge surprise. There are specific amounts that they pull back that matter. Now, 50% is not technically a Fibonacci number, but it is used on the tool because 50% is a lot of times people will get involved when it's pulled back halfway. There are other figures to be aware of, 61.8% of the move being pulled back. And then the 38 0.2% Fibonacci retracement level. And you can see that on the way up from this low, we pulled back right here to the 38.2% Fibonacci. Now the tool is on the pitchfork menu, and it is the retracement. Now there are other forms of Fibonacci that you can get involved in, but in this case we're just looking at the retracement. So the retracement from there was at the 38. So, like I said, it works in both directions. So the last swing high is what you want to draw this from, or the last peak high. And as I draw this has actually hit a minor Fibonacci retracement level, the 78.6. This swing high can be extrapolated down to here. And then there's the 38.2 again. You can see that we fell and then we bounced a bit and sold off. So think of it as a guideline. There are some people out there that will use just Fibonacci. I don't think that's the best use of it. I think it is something that you want to perhaps get involved with adding it to some other form of analysis, like your support and resistance lines. Now, your Fibonacci should be drawn from either a swing high or a swing low. It gets clicked and dragged, and then you just simply look at these areas for support. Again, though, I would caution against using it as your sole indicator. Now, that being said, if you combine an area of obvious support and resistance, on a longer term chart especially, you can perhaps set up potential trades later. So if we are to pull back in Apple, down here you can see that there is a clear support and resistance area right around $185. So as we drift lower, Fibonacci traders and support and resistance would both give you an idea as to, hey, this may be a great place to trade. You want to be looking for, a hammer, a bullish engulfing candlestick, something like that, a 3 candle pattern, something along the lines of that to really kind of add to your thesis. Because with trading, the best trades are the ones that are based upon multiple reasons. One thing that you will never see us do as professional traders is just to simply take a trade based upon one sole reason. So in this case, the 38, the 185 levels both look to be important. We're in an uptrend, so certainly you don't want to be a seller, even though, we could drop $20, $25 in the short term. Apple's been a winner for a very long time, so there's very difficult to go against it. Just as in the GE chart, it's been losing money hemorrhaging money for ages, now under $10. So you don't necessarily want to buy this based upon technical analysis. This is a sell-only stock. In this video, I'm taking a look at Fibonacci retracements and extensions. And Fibonacci is a mathematical pattern that tends to repeat itself in nature. If you want to know more about the actual numbers behind it and how they go about figuring out how the pattern was figured out in the 12th century by Leonardo Fibonacci, there's a ton of information in that. But suffice to say, it has a certain amount of predictive and repeatable presence in the world of nature and by extension, the world of trading. So clicking on the Gann and Fibonacci tools submenu, you can pull up a fib retracement. And a fib retracement is simply a ratio of distance that a trade goes before it runs into a particular resistance barrier. So there are multiple Fibonacci retracement levels. Without a doubt, though, the three most important are 38.2%, 50%, and 61.8%. So what that means is from the drop to the bottom, because you're measuring the entire move here, this swing lower, when it rallies, half of the move will have been collected here. With Fibonacci, you're looking to take the swing and see how far back can we pull before sellers come in and continue to push. And you can see we formed a perfect shooting star on the weekly chart here at the 50% Fibonacci retracement level. It's one of the most common ways to get involved is to look at the 50%, the 38.2%, or the 61.8% levels and look for price action like that to trade. And quite frankly, that's a very simple, straightforward type of trade that you find yourself in. You wait for the price action first, though. As we go lower, you will see traders start from there, and then they'll pull this up, and it's at the 50% again. We got a hanging man here, which was a sell signal, and you continue to go lower from there. Pretty straightforward trading, and Fibonacci does tend to work better on higher time frames. For example, you can do it like on a 5-minute chart, but really at the end of the day, it doesn't mean as much. Another thing is Fibonacci extensions. So you can do like a trend face fib extension on the same move. And this represents the 50% retracement. But then you get these things, these extensions, 1.618 or 161.8% extension. So this measures where can we go based upon the initial move. We've pulled back, we've entered, so we need a place to get out. Based upon Fibonacci extensions, that's the level you're looking for. And we formed a double bottom just below it. It's pretty straightforward. Do you want to stay into this trade? I mean, you could, and it certainly would have worked out. But since then, we've bounced a bit. The double bottom, again, price action, has told you that the move lower is certainly running out of steam. This is a perfect setup, typical type of Fibonacci trading. But there's a lot of other things you want to pay attention to as well. Price action, notice this is $40. Price action tends to form around these round figures anyways. If you go back to the support and resistance videos, remember that I had talked about every $10. So let me go ahead and do this again. So notice that the 50% Fibonacci retracement level is just above $30. $30 is what caused the trouble. We went down to 20, which is what caused the support, basically. We've bounced back here. We've fallen from there again, and we've gone down to roughly $10. So the best way to use these tools is to use the tools themselves, because they do have a certain amount of predictive power. And I think, quite frankly, it's just herd mentality. I don't even know if there's any magic involved in it. It's just, it works because people say it works. You have round figures here on the chart, and of course you have price action. So if you can marry the three, this is how you properly use Fibonacci. And you'll see examples of this everywhere. So let's go ahead and see if we can find, let's see what Tesla's got going on. So I'm going to go ahead and use the trend-based fib extension because it gives us both. We've had a nice strong move all the way up to here. We pulled back here. So let's take a look at this trade. The first thing that you should notice is that we have a pullback as we started to fall. You can pull back to the 50%. And a hammer right there. Well, what else is there? $120. It's a nice round figure. The move had initially tried to move to $200. That caused the resistance. Notice that we made it to the first extension, which is just at about $300. That being said, you can clearly see that there is a symmetric pattern going on here. These are all things that you can calculate. You've got the sideways action of the big figures, you've got the price action, candlesticks, and then you've got the Fibonacci. Remember, when you're trading, you're always better off to have multiple reasons to be in a trade. That's going to be true if you're using Fibonacci or anything else, but that's especially true in Fibonacci, because what you want is a confluence of not only Fibonacci traders, but you also want people looking at it for multiple reasons, the round figure. If you remember previously in support and resistance, I talked about needing orders filled. So that comes into play as well. You clearly want nice big swings when you attach your Fibonacci retracement tool to the chart. You want them to be at extremes if at all possible. So this massive extreme here certainly would qualify. And you're going to find that somewhere right around the 38 or so, or the 61, we have bounced and taken off to the upside. Again, you can see how predictive they are, but you don't just put up a fib and trade that. You put up a fib, you hope, and you become more interested in, if it's at a place like $50, and then you look for price action. If you get all three of those, then you have a winning setup. It's not a guaranteed setup, but there are enough things going on at the same time to get people interested. In this video, I'm taking a look at pivot points and one of my favorite ways to use them. I've got the cues in front of you, and this is a 15-minute chart. And this is the daily chart. And you can see we are in a bullish mode and have been at this point for several years. You see, we just continue to take off to the upside. At this point, as you know, and as I've tried to pound into your head this entire course so far, do not fight the trend. So now that we know that we don't fight the trend, we never fight the trend, it leads to heartache, we can look at pivot points. So I'm going to go to click indicators. I'm going to go to pivot point standard. Be done with that. And the thing about pivot points is I think they're somewhat reliable, but they should never be used by themselves. Now, they can be used much like a Fibonacci retracement or extension in the sense that they give you a suggestion as to where you should be looking. And ironically, one of the things that I find most useful for pivot points, and I use the cues because this is a perfect example of it, is that when you have a move going against the grain, against the longer term trend, a lot of times these pivot points are a great place to look for a trade. So for example, I'm going to take a look at some of these pivot points and some of these days, how they played out, and give you an idea as to what I'm seeing here. So for example, we're in an uptrend, as I mentioned. We gap lower during the day here, right at the open. This is 15 minutes into the trading session. Well, the first candlestick that we form is a hammer. We are well below the pivot. We're at support 2. We almost get to support 3. It's very rare you get beyond support or resistance 3. So as we formed a hammer here, putting your stop loss below support 3 makes a lot of sense. It's below the 181. You're getting in at about 182, maybe 182 and some change. So what are you aiming for? You're aiming at the very least for the next support level, if not the pivot itself. Now, you don't quite get to the pivot until the middle of the next day. But as you're closing out your position at the end of the session, you're closing out at 184. Not a bad little trade, $2 or $200 per lot minus commissions. So as I go ahead and zoom back, you can see that we gapped here, found support at resistance 1, and rallied a bit from there. That hammer makes a lot of sense to me, though. I would have the stop loss underneath pivot, and then as the thing moved higher, I would be putting it behind each one of these points. Now, why do I find this gap and this support okay? Well, it's because longer term, we're in an uptrend. That's really the basis of that. This is an interesting candle because we open up underneath the pivot and then rally on this huge bar. This big bar right here is reason enough to aim for higher pricing. Resistance 1 was always going to give you trouble. You knew that, but you could put your stop below the pivot and ended up working out at the end of the day. Not a major trade, not a great trade, but certainly worked out okay. As you can see here, we fell rather hard right away and ended up down at support 3 by the end of the day. So the fact that we reversed all of that was also another signal that that trade was going to be very strong. And again, keep in mind that it's very rare we get past support 3 or resistance 3. So at this point, if you are short of this just because of the gap, you have to be taking profits before you get there. And again, it's against the trend, so quite frankly, I would have ignored that. When it's with the trend, I trade it. And I say that in almost every video in this course because with the trend is what matters. That's what will bail you out of a lot of so-so trading decisions. Here's a gap lower. We find support at support 1 by the end of the candle. That's a buy signal. So where are we going? Well, resistance 1 would have been one target. Resistance 2 would have been another. You're not interested in aiming for resistance 3, although it's possible. But you recognize that resistance 2, support 2 are about as wide as the market gets. This hammer on support 1 after a gap lower in an uptrend, perfect trade. So this is how I like using pivot points. It's probably by far been the most profitable way. I use it as a signal to go with the trend when the market has perhaps thrown a bit of a tantrum. And you can see we gapped lower here. We found support at support 1, rallied to the pivot. That's a nice quick little trade. Kind of died out after that, but full disclosure, this is a Friday. So really by the time you get halfway through the session, you're losing volume anyways. No need to fight the trend. You just use these pivot points as an area to look for buying opportunities if the move goes against the trend. If it goes with the trend, then you can use them as support on the way up. I would say if I was to rate these trades, these pullbacks to support 1, possibly even support 2, and a supportive candle, that's like an A+ trade for me for a short-term scalp. The one that I pointed out here where we broke higher and then came down to find support at resistance 1, that's maybe a B+ trade, or B at best. I don't like these as much as I like this, because this represents that the Qs have gotten a bit lower, but the value hunters are coming in. We know it's worth more. The market has told us that for quite some time. Been in an uptrend. This, of course, has been a bit sideways in this area. And really, when you look back, and now the reason is it's because you can see support anyways. So that's what you look for. You always look for some type of secondary reason. The hammer, tertiary reason, the support, the support 1 line, the support 2 line, offering support here, the support 3 line not being broken. There's a lot of different reasons to be in this trade. So this is kind of the perfect setup. So again, look for it to gap away from the trend, form some type of supportive or resistive candle if it's in a downtrend, and take advantage of these levels. In this video, we're taking a look at how to identify market trends. We'll be using the exponential moving average and the MACD. The exponential moving average is an indicator that plots the average price of a security over in periods. You can select this. So, for example, if it's 20, and on this chart it'd be 20 days, it will give you the average price over the last 20 days. At each candle close, and it will just move up and down right along with it. The idea, of course, is that if it's rising, we're in an uptrend. If it's falling, we're in a downtrend. There are a multitude of moving averages that people use. They are a guide stick. I would not use them for much more than that. And the MACD is an indicator that has the moving average convergence divergence is actually what it's called. And you can see it's got moving averages, a quicker and a slower one. And then the histogram measures the difference between the two. It turns, on TradingView, it turns green if it goes positive, and it goes negative, it turns red. Both of these can be used to show the trend, or perhaps the overall attitude of the market, if you like. And you can see that there's the moving average. It places on top of the chart. You can change it by clicking this. So let's go ahead and do the 50, because the 50-day EMA tends to be widely followed. You can see that it is sloping up, so that tells you the trend we have been gaining over time. With the MACD, you can see that the histogram has been green this entire time, with the exception of a couple little moves. This area here, it went red, so the trend definitely was dropping, but the longer term trend was still higher. So this shows you a little bit of a confluence of a pullback in a longer term trend. I would not classify that as a negative trend, just simply a pullback. It's something that you typically get. You can see that the histogram in the MACD had gotten lower as we had risen. That shows that we are losing momentum, and that was your first sign of trouble. And then the low had gotten lower, so that shows that the sellers are starting to become more aggressive. There's a lot of different ways you can use these indicators, and they are some of the more common ones that you'll see. Another thing that people will pay attention to is moving average crossovers. So when the quicker one crosses over the lower one underneath, that's when you may start to see a little bit of momentum pick up. And we did to a point. It wasn't the greatest signal. But the most simple way to use this is to simply pay attention to the histogram, whatever side of the zero signal line we are on. Tells you what the mode of the market is, the momentum. And then, of course, if you use it with a moving average, like the 50-day, it can keep you on the right side of the market. So even though this was negative, the 50-day was still relatively bullish. We did flatten out a little bit, but we hadn't rolled over to the downside. So you would have known not to short. You can see that we went higher. And again, like I said, we got a little bit of divergence, lower momentum to the upside on the next high. And then you started to see the histogram go red, and it went really red. The EMA started to drop, and that's the sign that we're entering the downtrend. I'll go ahead and put these indicators back on this chart here, and I will use the same settings just to show you how it works. Okay, so this is your moving average convergence divergence indicator, just as we saw in the last time. And this setting here, I will change to 50 days again. You can see that the indicator gets a little flat here, and you'll see that when you're consolidating, but then we make a decidedly negative move. It lines up with the histogram right here, going very red all of a sudden, and that shows you which direction we're going in. Doesn't have a lot of momentum. It's a very gentle downward move as the histogram is fairly weak. We got a nice little pop here, and we did break the moving average, but the moving average hadn't turned up yet. So this just shows you that we've had a nice retrace. And once we break down below there, the red picks back up and we start to fall with a little bit more authority. These two indicators are quite often used together. They are some of the more common indicators, although, again, price action will be the main trigger. So you'll learn more about that later on. The right candlestick at the right time with these indicators makes a huge difference. But you do need to have an idea as to what the histogram means, the slope of the moving average. The average price is falling over the last 50 candlesticks, etc. It gives you an idea of which direction in the market you want to be in. In this video, taking a look at Bollinger Bands. Now, Bollinger Bands, if you remember your old math classes, there were the bell curve, the standard deviation, and 95% of action was within 2 standard deviations of the norm. So the idea is that price can get a little ahead of itself, a little lower overbought, oversold. That's essentially what you're using. The Bollinger Band indicator is a moving average in the middle. The 20 SMA, simple moving average, is the default for most platforms. So you'll have the moving average like you learned about in the last video. And then you'll have bands that form around it that show +2 standard deviations, -2 standard deviations. And keep in mind that this is the normal price, the trending average price. So let's click on indicators, click on Bollinger Bands, and you can see that we have a middle line here. This is your 20 SMA, see 20, based upon the close, and then two standard deviations. So these lines, this is 2 standard deviations higher, 2 standard deviations lower. So when you look at a Bollinger Band, you should think of it as a couple indicators in one. So you have the moving average, you have the standard deviations, you also have the width of the standard deviations. So what I mean by that is in a more volatile market, they'll spread out because your average price swing and your average price for the day, in this case, is much higher. In a very kind of quiet, range-bound market that isn't doing much, you can see how thin it gets, and that shows you that the market just isn't very volatile at all. So you want to pay attention to that. Now, with all things technical analysis related, the first thing you want to notice is the trend. So when you have a slight lower or upper moving average, it's not a lot to do with the Bollinger Band. when you get a compression, then that tells you that you could get an explosive move rather soon. So let's go ahead and take a look at a couple runs here. We have broken higher. We've hit 2 standard deviations above the norm that is grinding higher with it. And you can see that we come back and we find support there. So the idea is that you can use the moving average as support. And you can see that if you just simply followed right along, you could have made quite a bit of money. But there does come this point here. So for example, this candlestick and this candlestick and this candlestick all catch my attention. And the reason is that they break out of the standard deviation band. And the one on the far left over here and this one are particularly interesting. And that tells me that perhaps it's time to exit a long position. This one tells me that we are starting to pull back. It's a shooting star. But when you close outside of 2 standard deviations, you are getting a bit stretched. So if you're long, this could be a reason to exit. Now, some people will short and try to aim for the other side. That's a bit riskier because you're not going with the overall trend. Another thing that you will sometimes see is some traders will actually look for a compression like this. And then once we explode to the upside, if you think about it, it makes sense that the first couple of candles do close outside of the standard deviation because we haven't been doing much lately. So what they'll do then is they'll just dynamically move their stop loss right along with the moving average to try to catch as much as the move as possible. Because clearly you had a breakout here just based upon support and resistance and then a close outside of it. So you could have gotten long here and gotten out here for a nice multi-week gain because this is a daily chart that I'm looking at. The moving average starts to roll over. We close below. You could look to short next time we touch it. And you can see that it just kind of rinses and repeats just time and time again. An explosive move to the upside, formed a shooting star, but we broke above the shooting star, which is a very bullish sign. And you could see that that was probably a break even trade if you did the stop loss at the moving average thing. But you also had a shooting star close just outside of it, which, as I mentioned earlier, is a sign that perhaps we're getting ready to pull back. So you could have gotten in here, got out here, or here, just kind of depending on how you played that. Bollinger Bands, for myself, I found them to be extraordinarily useful for determining when a stock may move violently because of the compression. That's my favorite use for them. But there are a multitude of ways to play this. So just by all means, do stick with the trend, though. This is slightly bearish trend, so you could make a little bit of money selling. But then again, when you look at the longer term attitude of the market, you would have expected support there. So it's a tool. It's not, unfortunately, some people use Bollinger Bands as a complete trading system. And I think that's somewhat dangerous. You never really want to use just one thing. Price action, support, and resistance are the bedrock. And then you can add this on top of it. So for an example, let's go ahead and draw a horizontal line here at this previous resistance. So you would have known that somewhere around $32-ish there was resistance. And you would have also known that there was support here. So it makes sense that there's going to be a lot of buying pressure in this area. And that's exactly what we saw. So where's your signal? Well, your signal could be every time you break above this moving average. But quite frankly, I think the most interesting candlestick is the shooting star that formed here at a place where you would expect to see selling, and then it gets busted through the next day. If you don't like that, a return to the moving average, you would have had to wait a couple of weeks, but you got a nice opportunity there. At that point in time, you had multiple trades that would have worked out. Bollinger Bands are good, but you have to use them as a tool, not an entire system. In this video, the stochastic oscillator. So, Stochastic oscillator is another oscillator that is in its own window. And I'll go ahead and pop that up here. Basically, what it does is it measures a couple of moving averages and whether we are overbought or oversold. So it's a lot like the RSI. We have above 80 and a crossover gives you an overbought signal. Below 20 and a crossover gives you an oversold signal. There is price divergence, and I'll walk through that as well. However, there's a caveat with stochastics, as they are horrible in a trend, and they are much more reliable in a range-bound market, because the idea is that all things being equal over the last X amount of periods, in this case 14, there's a high and a low, and you just kind of bounce back and forth. The reality is markets do consolidate, depending on the market, anywhere from 70 to 80% of the time. So the stochastic oscillator is a good indicator. You just have to make sure you're using it at the right time. So what I will do, a lot of traders will do this, is they'll put a moving average up. This is a 50-day EMA. And you can see that it's drifting slightly lower here, but it's more sideways than it was here. So what does this tell us? This tells us that we will get a lot of false signals out of the stochastic in this uptrend. But once we become a little bit more range bound, and you can clearly see that there's a couple areas that we're trading between, somewhere around 145 and maybe 130 or so. Now you can start to use the stochastic oscillator. And you'll see that the moving average is crossed over in the overbought area right at the top. We crossed over here, and that's technically not a buy signal because it wasn't underneath the 20. There's one here, and you can see that's when we started the consolidation. At that point, you can see that the EMA was starting to roll over, flatten out a little bit. So we've had two signals. This was awfully close. You could have perhaps been talked into it. But as you can see, technically it's not there. So the stochastic is a little slower than some other signals or signal producing indicators, and that in and of itself can and will keep you out of trouble sometimes. So let's take a look at, let's do Ford Motor here, and you can see that we're in a trend. Even though we've popped above, now that we're sideways for this time frame, you can see that we just kind of went sideways for a few days and we crossed there. That technically was a sell signal. This was more or less a sideways market for a little while, at least based upon the moving average. And you can see that we did get the one signal. This area here, we got a signal here. We did cross over just barely. This is an excellent signal. We crossed over right here. And we crossed right here, telling you to either get out or go long because you would have been short. This was a sell signal. And that was a closing signal because by then the moving average started to drift lower and you did make a fresh new low. So at that point you have to assume that you're probably not going to continue much higher on the rebound. There is price divergence, as you can see. And that, of course, is a signal. So with the line going basically sideways, getting a little overbought, crossing over there makes sense. And we did, in fact, go lower over the longer term. And that's the thing about the stochastic oscillator that I would point out. When you do get price divergence, it tends to be a little bit more of a longer term signal by the very nature of the indicator itself. But again, you have to be very careful. You have to make sure that you're using it in a range bound market like this. You know, there's a sell signal there. There was a buy signal right before it. So a couple decent trades. Most people will use these moving averages to give you an idea as to whether we are sideways. Another thing that, of course, helps is if you're at support and resistance, and in an area that has two strong levels of support and another level of resistance, two conflicting areas, typically you will have consolidation anyway. So that should get you looking at the stochastic as well. In this video, I'm taking a look at reversal trading strategies. I do not condone reversal trading whatsoever in the traditional sense. What I like is trading within the trend. So in this case, we're in a downtrend. We get a pullback. I like shorting that. It's a reversal of that. You are not trying to go against the trend. I can not think of a better way to lose money. So having said that, Deutsche Bank clearly is in a very negative trend on the daily chart. So as a day trader, you may want, I don't know, the 15-minute chart. Maybe you're looking for that. And you can use the MACD. And the MACD is an indicator that has a couple of moving averages, and you can see that we have crossed in the overbought area, and that signal is when you're looking to sell. You can see that that did lead all the way back down to here and beyond. Yes, there are places where it crosses to the upside, but we ignore that. You have plenty of stocks out there to trade. You don't need every penny of one particular stock. That's a sucker's game, and it's a great way to lose your account. This being the case, you can see that we've had a couple crossovers here. It got a little bit expensive on the MACD. We broke down eventually. The stop loss will be based upon support and resistance. So if you shorted here, your stop loss would have been above this next cluster. You can see that we had a nice little rally here. We crossed at an extreme in the overbought part of the MACD above the midline, right at a resistance level. You can't ask for a much clearer signal than that. So other ways that you can look at this might be Bollinger Band. So Bollinger Band, and in this case, we're in a downtrend on the daily chart. You're looking for areas where price has broken the top of the Bollinger Band, meaning that it is more than 2 standard deviations away from its moving average, which in this case is 20. You short there, you put a stop loss on top of the Bollinger Band, and you continue with the longer term trend. Same thing here. You have a stop loss here. You break below the Bollinger Band here, you take your profit. That's the thing. You're looking for when you go in and out of the Bollinger Bands. You are not looking to buy on a break through the bottom in a downtrend. You are looking to take your profit. Every time you get overbought, it's time to sell because you know the larger players are still shorting this market. So Bollinger Bands can help as well. And then obviously, support and resistance, which quite frankly is the most important thing on the charts because that's where the buyers and sellers are. We're in a massive downtrend here. We have shown resistance there. You can see that we didn't make it above there. We have shown resistance there, which offered support, and then we broke through it. It offers resistance. And this is a simple matter of following the trade once it breaks through these levels and placing your stop loss behind each one of these. Eventually, you'll get knocked out. But this way, you can have the market tell you when it's time to leave. I cannot stress enough that you should not be worrying about these pullbacks. If you don't believe me on the daily chart, you can see that during that time frame, we had some nice pullbacks, but we're still going lower, and that's all you need to know. You do not go against the market. In this video, we're going to take a look at choppy markets and how to deal with them, really. So a choppy market is something that you should be very comfortable with because, quite frankly, it's the norm. 80% of the time, 75% depending on the instrument, markets are doing this as opposed to this. Now, you notice I'm on a 5-minute chart, so I'll go ahead and zoom out. This is more of a day trading thing, but it can apply to longer term charts as well. But a day trader is, by their very nature, going to be hyperactive as far as trades are concerned. So there are a couple of indicators that you could use to perhaps help. One would be the stochastic oscillator. And this indicator measures when something's overbought or oversold. Ultimately, you want to define where support and resistance may be and simply trade back and forth. However, one thing that I would point out is that you almost always have a prevailing trend ahead of time. Most of the time, the expression is consolidation leads to continuation. So the way that I deal with this is I will take a stochastic oscillator, once we start forming, and there should have been support there. There was a gap. Once we get this stochastic cross, the moving averages cross underneath, in this case, the 20, which is the oversold, you're looking to buy. And once you get into overbought and cross, which is above 80, you're looking to sell. Now, here's the thing. The longer term trend, in this case, was up. So you're going to have much more luck buying. So how do you manage that? Well, if you really must trade in both directions, and quite frankly, I don't recommend it. I recommend just looking for support and going with the longer term trend, because eventually you break out of this. But leaving that alone, if you feel that you ultimately must do this, a simple trick that I have used for money management has helped me over the longer term. So I take the stochastic oscillator, I use that as a signal on with trend trades. I risk a whole unit. So whatever that is, let's just say I risk 1% of my account. Not with trend. I'll just put not with or NWT here. I'll risk 0.5%. So what happens? This gives us the opportunity to perhaps walk out of here with a little bit more clarity. You can see that we bought here, we hit resistance, got oversold. So at that point, you've got a 1% trade that worked out. But watch what happens. Your 0.5% goes against you. So, now you're down to only a half a unit of profit. And it's actually not even quite that. It's more like 45%. You get an oversold condition just above support. And you could have closed out there for an entire move. So then you're at 1.5 trades, units, if you will. So you've made money by going with the trend. Had you shorted here, not ahead of the resistance, that would have been a loser and you'd be covering your trade. Couple rules are this. If you get, the thing about trading choppy markets like this, if it proves you wrong, so for example, you shorted right here and it gapped up there, get out. You absolutely must get out, because a lot of times these can lead to much bigger moves, as you see here. So let's go ahead and take a look at letter X here on the day and see if we can identify something similar. So the daily chart, same thing. We're just kind of chopping around here. We kind of begin to form a little bit of an area of choppiness. It's consolidation. That's really all it is. You get a sell signal here in the stochastic. You recognize that this is support. You get out there. That's your half, because longer term we had been going up. You get a cross here, but not a signal. So you literally only get this entry to the upside as we cross there, and you get your one. So you got 1.5 trades. Now, eventually, you get this cross that's in the middle, like I said, and that's not a valid signal. That's a 50-50 ball. We do break above and we gap higher. Well, now it becomes an entirely different set of circumstances. So you've picked up 1.5 wins while the market was chopping, and then you continue to go further. Let's go ahead and, just for the sake of argument, let's do Walmart and see if we can find a nice choppy time in the market. So you can make an argument for this. being a choppy time of the market. But even that is a little suspect because it's more like an arch. So you do need to recognize that basically what you're looking for is something that's definable, because if you can't define the support and the resistance easily, that's not a good sign. Here you had an area where, we had been rising. You had a buy signal here. It hit the resistance. You had another close to a buy signal here, which you could have taken, I suppose, if you used a little artistic license. But you can see we broke out and went to the upside. So you had 1% and then you had a completely different trade. And that'll repeat on and on. So by all means, choppy market strategy, pretty simple. Really comes down to money management. You'll hear a lot of, you can use this indicator and you can use that indicator. I just like using an oscillator that shows overbought or oversold. You can use RSI, but I found the stochastic oscillator tends to work a little better in sideways markets. And this one, we're going to take a look at flat market strategy. So what's the difference between choppy and flat? Well, choppy is back and forth where you see peaks and valleys. But when you get a flat market, there are no peaks and valleys. Not really. And that is what we're looking at in a couple different areas in this chart. Flat markets are the worst, quite frankly. They don't give you much to work with. You can see, like, this is a 15-minute chart, and yes, it's zoomed out, but you can see we didn't do anything most of that day. We didn't do anything most of this day. And quite frankly, there isn't much to do with a flat market. Each one of these 15-minute candles tell you that the market just has no desire to go anywhere. So the best strategy for dealing with a flat market is letting it tell you where it wants to go. Ultimately, a flat market typically is nothing more than consolidation. It's just a market that has no real catalyst to do anything. And you'll see that a lot when there's no earnings or anything anywhere near. This is a flat market here. Now this I would consider a choppy market. We're in a range. While this technically is a range, we're talking about a range of 25 cents. We're not talking about a whole lot of trading. Now you can zoom in and go back and forth and treat it as a choppy market on the 1-minute chart if you wish. But in a world where there's over 5,000 stocks to most of you available to trade, of stocks and ETFs and everything else, there's no point in doing that. You don't need to punish yourself like that. So keep that in mind. But when you do get these flat areas in these stocks that just really haven't gone anywhere, the next thing you're looking for is some type of volume spike. So, for example, here we did nothing for 24 hours, basically. Well, for a trading day. We rallied a little bit and just went sideways. You can see we get this huge, massive spike higher. $2 spike on this 15-minute candle. So here's the thing. Do you have any doubts as to where this market's trying to go? You can put your stop loss on the other side of that flattened area because you know that there are a ton of orders right here that would have to be taken out for you to be hurt. You may have to be patient. You may have to deal with a pullback. In this case, you really didn't. But a pullback is not that uncommon, and just recognize it's part of the market structure you typically see. So you do have the option of waiting for a pullback to buy, but typically when you get an explosive candle like this after a market has done nothing, the pullbacks are very brief and very shallow. And you can see that with your stop here at, say, 29.30, and even if you bought here at 32, you're looking at about $2.50. You made $5 before the market flattened or got in a choppy range. So that was a 2-to-1 risk to reward ratio kind of built into this trade. You'll see this time and time again. Here is a massive sell-off. Now, I'm the first to admit that this would be difficult to start shorting down here after that move, but you can see that certainly it worked out. Same here in John Deere. You could call this choppy if you want. I call it flat because there aren't, this is more choppy because it's a little wider. And there is a little bit of art to this. There is no, hey, this is a flat market because it's X amount of percentage move. It's more a visual thing. It's when you look at a market and you go, there just isn't enough there back and forth for me to be bothered with. And then you get a volume spike like that, a massive candlestick. That tells you right there that the market's ready to go. And that's really the only way to handle these markets that I've found that's even remotely reliable. Beyond that, what you really want to see, and in this case in Deere it was obvious, we had been bullish for quite some time. So it shows you that there's more conviction coming. We like continuation in these setups. In this video, I'm going to touch on trading psychology and risk management strategies. Now, this is an area of trading that, quite frankly, takes up its own course most of the time, or even books. There's huge volumes of books written about this one subject. And that's because one thing that I would point out, and it took me a long time to learn this, that, anybody can learn to read a chart. The question is, can you hang on to the trade? Can you recognize when it's time to get involved? And can you accept losses? There are a lot of different things out there that you need to pay attention to when you get involved in a trade. So, for example, I've got Goldman Sachs in front of you, and you can see we formed a bearish candle right here at previous resistance, and you sell, and that's fine. I could teach anybody to do that. That's not the hard part. The question is, are you comfortable as it's going against you? Do you accept the fact that not every trade is going to work out for you? An analogy that I would use is that a lot of you have retirement accounts out there. And the retirement account, let's just say it brings back, just 10% a year. That's probably pretty decent, steady returns in a retirement account. Some years it'll be 5%, some years it'll be 15%, whatever. But, if you average 10%, you're relatively happy with that trading activity. So the question then is, do you micromanage every trade that the fund manager takes? Well, of course not. You're not going through and saying, okay, well, you lost 2% here, you lost 1.1% here, you gained 2.6, that's great, and you gained 1.1, but, what are you doing losing 0.5% here on this trade for, whatever the trade was? No, you look at the total returns. And that's something that you have to focus on. You can't focus on any one trade. That's the hardest thing for some people to do because you get very emotional. But you have to understand that sometimes things just happen. You can have the best technical analysis in the world, and you can have what looks to be a sure thing just blow up in your face because of some random comment from a central banker, or a scandal in a company, or a multitude of other, a hurricane, an earthquake, whatever. So one of the best ways to look at this and to take advantage of the markets, but also make it so that you can stay in the market, is have a risk management strategy. And in my case, I only risk 1% on any particular trade. So, and that's 1% of the total portfolio. So just to keep things simple, let's say it's $100 in my little, portfolio. And I risk 1% and I lose, and that puts me at $99. And I risk 1% there, and I lose again, and that puts me, instead of 98 this time, it's 98.1. And then I risk 1%, and my 1% brings me back a little over 98 cents. So I'm back over 99 slightly, and so on. When you get that type of reaction, your equity curve is going to look like this. It's very steady. You can function. The problem that a lot of traders get is they worry too much about the destination and not the journey. So what they'll do is they'll risk 5%. And in the same portfolio, a little $100 portfolio, you lose that 5% and then you're down to $95. Okay, well, it's not the end of the world, right? So you gain 5% after that. Well, you're no longer talking about $5. It's less. You're actually at 99 and some change. So that's the paradox here. You lose 5%. Now it takes about 6% roughly to get that back, to break even. So it becomes even more difficult because remember, the trade is going to work out one way or the other. And the market doesn't care that you need 6% this time instead of 5%. And the reality is a 5% move might be rather difficult to get in whatever market condition is. What if it's only 3%? Well, you're kind of on your way back, but you haven't made it. And 3% after 5% loss is roughly halfway. So again, you have that issue. I mean, the reality is that you need to stay in the market. Your number one job is to make sure that you keep your capital in your trading account. You must protect your capital. And the easiest way to do that is to simply risk something that you're comfortable with. And being comfortable is the next point that I would cover. You should be comfortable enough that you can short this candlestick here, for example. You can put your stop loss above it, and you can just let the market do whatever it's going to do. Say you have a target down here, and you see it did work. You know, it was the middle of the next day, but let's just say that was your target. Well, there's no reason to get out of the trade until the stop loss is hit, and you have to be comfortable enough that you can walk away, quite frankly. You don't have to sit at the computer white knuckling the whole time. Well, let's look at a little bit more common chart maybe for a day trader. You get an extremely bearish candle there that you decide to short, and you recognize that there's probably going to be support there, so you just try to pick up, say, 50 cents. You put your stop on top of that candle because if we break above there, that would negate that signal, and you hit it. But are you going to sit here and white knuckle it for 30 minutes? Or are you just going to let the market do what it's going to do? Because it did move up a little bit against you. You know, are you going to freak out? The first couple ticks you get against you, oh my God, I'm going to lose money. This is why, and this is another thing that helps with the risk management, this is why you will hear me more than once through the course talk about what's the longer term trend. Trade with the longer term trend. Yes, I realize, and I don't even know what the longer term trend is on this chart. Let's pull up the weekly. Okay, well, it's been a lot of downtrending here recently, so it makes sense that you would be more of a seller, but you are approaching support. During this time, there would be, frequent pullbacks during the day, but, it's not that you can't get that money, but quite frankly, it's just easier to go with the trend. And that will more often than not make the markets a little bit more forgiving of your trading. There is a huge list of things I could be going through, but suffice to say, position sizing, comfort. You have to be psychologically comfortable. You have to realize that this is a marathon, not a sprint. So one loss of 1% isn't going to end your trading career. You don't need to get it back right that second, because if I told you, hey, at the end of the year, you're going to be up 33%, and you knew that was the outcome, then why would you sweat a 1% loss? And that's something that you're going to see a lot of. You're going to have a lot of days. You're going to have days where you have 3 or 4 losses in a row, where you're just on the wrong side of the market and for whatever reason can't get a handle on it. Those are the days you get up and walk away. You just cool off. You give yourself some time away from the screen, and then you can approach the market maybe later in the day or better yet the next day when things have calmed down. Honestly, anybody can read a chart, but it's what you do with the trade once it's in play that truly matters, and position sizing. I would be willing to say that psychology is probably 85% of trading quite easily. Now, you need to have the tools to read the charts and understand where the market may or may not go, but you have to understand also that, and truly understand this and accept that just because it looks like it's going to struggle to get above 238 on this chart doesn't mean that it can't. So keep that in mind as well. Take a breath, relax. You're in it for the long haul. You're going to learn to enjoy the process. I promise you, if you spend enough time doing this, there's a lot of highs and lows, but at the end of the day, it's a smooth equity curve that will calm your nerves. Now that we're done with the course, I just wanted to take a quick moment to thank you for viewing and hope you enjoyed all of the information within. Remember, if you have any questions, feel free to reach out to us or perhaps post a note on the forums. Again, thank you so much for watching and happy trading.